Moody's just dropped a bomb on the US, a credit downgrade that could increase your rent, decrease your savings, even cost you your job. And almost no one's talking about it. But the real question isn't what they did, it's why now and what happens next. Because this is the third time in history the US has been slapped with a downgrade by a major credit agency. And the real fallout wasn't what people expected. Now, to most, this sounds like some boring Wall Street news, but when your livelihood and very well-being can be crushed overnight, it matters. Here's the deal. Moody's, it's a major credit rating agency that assesses the financial health of governments, companies, and financial products. Think of it as a financial report card that indicate how risky it is to lend money to a particular entity. Well, they just downgraded America from AAA to AA1. That's one notch. But it's not about the letter or how much, it's about the why. They basically said, hey, your debt, it's out of control. And y'all in DC, you've been arguing for a decade with no real fix. And this isn't even the first warning the US has had. Standard & Poor's pulled the plug first back in 2011. Then Fitch followed in 2023. And Moody's, they've had enough. But if all three are saying the US is risky, why is no one panicking? Because it's like this. Imagine maxing out your credit cards, then asking for more, and your bank finally says, we're gonna have to pass. We don't trust you like we used to. That's what just happened to the US government. That's why rents are on the rise, why grocery prices feel insane, why everything feels a little bit more expensive. It's all connected. And every time Congress kicks the can down the road, this debt monster we call the national deficit, it gets a little bit bigger. So what does this downgrade really mean? Well, it's a warning shot. The US, they haven't defaulted yet, but the cracks are there. And when you ignore 3 fire alarms in a row, you typically don't get a fourth. You get a fire. And it's not about just whether or not Wall Street will burn. It's about what you can do before the flames reach your paycheck. So what does this fire look like? I mean, how will you know when it's getting close to your home? It starts with a missed payment. Treasury bonds get questioned, and suddenly the thing the entire world treats as risk-free isn't. But here's where it gets weird. Instead of trying to put out the fire, it seems as if Washington is just throwing more gasoline on it. President Trump is pushing his one big beautiful bill, a massive tax cut package that, according to independent analysts, could add over $3 trillion to the national debt in the next decade. Moody's cited these fiscal concerns when downgrading the US credit rating, warning that the government's ability to manage its debt is weakening. Yet, the Trump administration dismissed the downgrade as a lagging indicator, attributing it to previous fiscal policies. Trump and his advisors argue that bold tax relief combined with spending restraint will invigorate the economy and ultimately keep the nation's finances healthy. They tout the plan's unprecedented cost savings and project that a surging economy, aided by low taxes, regulatory rollback, and even tariff revenues, will prevent debt from spiraling. And while Trump and his critics go back and forth, the markets are reacting. But the real blowback, it's happening quietly. In the bond markets, in currency shifts, and in how foreign investors are repositioning their trust in America. Some investors, many of them, are nervous, but not all of them. Big players like Morgan Stanley and Goldman Sachs are still very bullish on the US, betting that the economy's strength, innovation, and deep capital markets will carry us through. Something you won't hear on CNN for 1,000, Alex. Even global investors like Kuwait's sovereign fund say there's nowhere safer than the US, flaws and all. So yeah, Moody's fired a warning shot, but to many on Wall Street, America is still the least ugly house on the block. So while the flames may calm for now, the next spark, it's coming. And the real question is, how do you protect yourself? Let's break down the 5-step strategy to not just survive the collapse, but profit from it. So here's what happens if the fire reignites, and this time it's not extinguished. Confidence evaporates. Investors, they stop trusting the US bonds. They dump them, or just demand higher interest just to keep buying them. Interest rates explode, not just for the government, but for everyone. Mortgages, car loans, credit cards all get more expensive, instantly. Markets crash, stocks nosedive, retirement accounts bleed, banks tighten up, and borrowing dries up. Prices skyrocket. The dollar weakens fast. Anything imported, fuel, food, electronics, becomes more expensive overnight. Bank runs start. If people think the dollar's collapsing, they try to get out of it fast. That means chaos at ATMs, credit limits slashed, and panic setting in. Global dominoes fall. Since the US dollar backs global trade, a default triggers a chain reaction, shaking banks, economies, and currencies all over the planet. That's the fire. And if you don't have a plan, you burn with it. So here's a plan, and it happens to be my plan, as well as the plans of the wealthiest people I know. Flip the script and use the system against itself. Pull a full reversal, a counter strategy to legally exploit inflation, weaponize debt, and protect yourself with hard assets, while the system quietly crumbles. I'm calling it the exploit and escape strategy, also known as how to win when the dollar is dying. Step 1, hedge with gold and Bitcoin, because you don't go all in on one basket. If the dollar takes a hit from inflation, policy, or panic, hard assets shine. Gold is stability, proven for 5,000 years. Bitcoin is volatility with a moonshot upside, the anti-dollar for digital age savers. Allocate 5 to 10% of your portfolio into a mix of physical gold, specifically coins and bars. Cold stored Bitcoin, not on exchanges. An option would be gold-backed crypto or ETFs if you prefer convenience. And you'll see how gold becomes the hero of this plan after step 5. But first, step 2, flip your thinking about debt. Because most people fear debt because they associate it with consumption, like on cars and shopping and vacations. But the rich use debt to buy control, to buy cash flow, assets that pay them monthly. Bad debt, that's short-term, high-interest loans on depreciating stuff. Good debt is fixed rates, long-term, low-interest loans on income-producing assets. Step 3 now, secure cheap debt before it gets rationed, because as credit ratings fall, interest rates rise and banks tighten lending. Right now, you can still get long-term fixed debt at today's rates before the full downgrade effects hit. Apply for personal and business lines of credit. LoopholeLending.com is a good source for this. Use seller financing, subject to or wrap mortgages whenever possible with your asset purchases. Secure credit from fintech lenders and 0% business cards. Lock it in now. Lock all of them in now before the rules change. Step 4, buy income producing real estate, because real estate gives you 3 key advantages. 1, cash flow. Rents rise with inflation. Leverage. Use other people's money so you can acquire more. Tax breaks, depreciation, and interest deductions. And focus on small multifamily properties, in single-family rentals, in landlord-friendly markets, and creative financing opportunities. The rule of thumb here is 60% of gross rent should cover all expenses before debt. If it cash flows with today's rate, it'll explode when you refinance later, or flat out disappear. More on that in just a second. Step 5, inflate your way to wealth, because inflation makes your debt cheaper and your assets more valuable. So if you bought real estate today with a fixed loan and inflation keeps going up, you're paying that loan back with weaker dollars, while your rent and property value are rising. That's how the wealthy use inflation to win. It's like when you bought your first house or even a car. At first, that monthly payment might have felt like a stretch, but a year or two later, it felt normal, it felt smaller. Your income went up, that's why, but the payment stayed the same. That's inflation in action. Here's the key to using the system against itself. If you can handle the debt early on, inflation will start working for you. Over time, your income rises, but your fixed payment doesn't. The trick is staying afloat long enough for that flip to happen. Now here's the wild card most people miss. If the dollar collapses hard and fast, like it could should the US miss a debt payment, your debt, priced in dollars, collapses with it. But your assets, like real estate or gold or maybe even Bitcoin, they hold their value or even spike. That means a loan that once cost a pound of gold to pay off could cost you just a few ounces after the crash. That's the kind of wealth shift people don't see coming. unless they're already holding the right assets. That's the 5-step exploit and escape strategy. I put it in a document for you below. Hey, quick thing before you go. I'm running this weird experiment where I basically pay people to do real estate deals for them. And then I split the profits with them 50-50. And you can watch this right here to get all the details. And yeah, I know it's probably the most ridiculous offer that I've ever made, but it's working like crazy. And if you're thinking there's a catch, you would be right. I can only work with 2 to 3 people per city. So if you're curious, check out this video here to see if your market's still open. Or don't. It's not for everyone. Thanks for watching though. I'll see you next time. Take care.